Welcome to Sheen Research, your strategic partner in comprehensive investment analysis.
Today, we are launching a full investigation into Constellation Brands. That's ticker STZ.
We're going to be looking at their second quarter for fiscal year 2026, which ended back on August 31st, 2025.
And this quarter, it really is a study in contrasts, isn't it?
It is. You've got this powerful, long-term strategic vision, continued expansion in Mexico, clashing with some really severe, undeniable short-term economic pressures.
Exactly. The headline numbers, they scream volatility. But there was a significant surprise on the earnings side.
A very welcome surprise. If you were just looking at the bottom line, Constellation delivered quite a bit of relief. Their comparable earnings per share, or EPS, came in at a really robust $3.63.
And that didn't just meet expectations. It blew past them. It beat the consensus forecast by 22 cents.
Which tells you a lot about their cost management, right?
Yeah.
Their efficiency initiatives must be firing on all cylinders. We'll definitely have to dig into that later.
For sure. But while that EPS number was a breath of fresh air for investors, the revenue story is, well, it's a lot more complicated.
It requires some immediate context because of that huge portfolio restructuring they've been doing in the wine and spirit segment. The total reported revenue was $2.48 billion.
And if you just look at that year over year, it's a huge drop, a 15% decline.
Which is, frankly, alarming on the surface. But the key word there is reported.
Right, that 15% drop is mostly, financial noise from their strategic cleanup.
So when we strip out the impact of selling off all those lower margin wine brands, the organic picture, while still down, is much, much less drastic.
The organic net sales figure was also $2.48 billion, but that's an organic decline of 8% year over year.
And that 8-point difference is just so critical. It shows the massive scale of the portfolio trimming and stops us from comparing apples to oranges with last year.
Indeed. But even with that organic lens, an 8% top-line decline is still significant pressure. And that flowed right down the income statement.
So diving a bit deeper into the bottom line, their comparable operating income was $886 million.
Which is a year-over-year decline of 13%.
And consequently, the comparable diluted EPS also fell pretty sharply, down 16% compared to the same period last year.
So it's one of those quarters where, despite beating earnings estimates, the underlying volume dynamics and that restructuring pain created some major drags on profitability.
So our mission today is crystal clear. We need to untangle these results. We have to figure out what's temporary noise and what might be a real structural weakness.
For the beer segment, which is the engine of the whole company, we have to ask, is this sales slowdown cyclical or is it structural? Is it the economy or something deeper going on with their consumers?
And then for wine and spirits, we have to analyze those crazy margin shifts that led to a negative operating income this quarter. They're now totally focused on premium brands. So is this brutal transition year setting them up for massive success?
That's the million-dollar question. So let's unpack it, starting with the heart of the business, the beer segment.
This is where the story gets really interesting because the beer segment is Constellation's golden goose. It's the engine that funds everything else.
But even that powerful engine slowed down significantly in Q2. We have to figure out if the engine is seizing up or if it just, hit a speed bump.
Looking at the core beer segment financials for the quarter, the results were pretty sobering. Net sales hit $2.3 billion.
That's a decline of 7% year over year. And operating income saw a similar drop, settling at $951.6 million. That's a 12% decrease.
And this pressure on volume and income, it immediately hit their profitability. The beer operating margin fell from 42.6% last year to 40.6% this quarter.
That's a 200 basis point contraction. That's 2 cents less profit for every dollar of sales. It's a serious leakage point.
And we absolutely have to scrutinize the cost structure that drove that. We'll get into that in our next segment, especially how they're absorbing their fixed costs.
But what really complicated the picture this quarter was the divergence between shipments and depletions.
Right, the classic indicator of inventory backing up. Shipments, which is what Constellation sends to their distributors, decreased by a sharp 8.7% year over year. That's 117.4 million cases.
However, depletion volume, which is the actual sell-through to the consumer from the distributor, saw a much less severe decrease. It was down just 2.7%.
And that discrepancy, where they shipped almost 9% less, but consumers only bought about 3% less, that's a key signal. It means product is moving off the shelves faster than they're refilling the warehouses.
The company addressed this directly, which is crucial. They explained it as a necessary distributor inventory rebalancing.
So distributors were expecting a stronger summer, maybe held a bit too much inventory, and this was basically a true-up.
Exactly. Constellation had to slow down shipments in Q2 to let those distributors get their stock levels back to normal. And management explicitly said they expect that shipment to depletion gap to align in the back half of the year.
So if they're right, then the Q2 shipment weakness was just a timing issue. It's tactical, not a consumption crisis. The underlying demand being down only 2.7% is way, way better than an 8.7% shipment plunge.
But it always raises that critical question, doesn't it? How much of that rebalancing is just a nice way of saying demand was softer than they thought and distributors were slow to react? The market has to trust that 2.7% number.
And that leads us right into the huge debate analysts were focused on. Is this slowdown a structural problem, or is it a cyclical one?
Management's argument is firmly in the cyclical camp. They see this as being driven by macro factors, things outside their control. They are not seeing deep structural issues with their core business thesis.
So in their words, it's a temporary recessionary attitude, not a permanent rejection of their products.
That's the story they're telling. And they backed it up with some hard data from their monthly consumer surveys. The core challenge they cited is just widespread consumer anxiety.
They found that a staggering 80% of consumers, both Hispanic and non-Hispanic, are seriously concerned about the socioeconomic environment.
And even more telling, 70% are specifically worried about their personal finances, paying bills, covering costs. When 3/4 of your customers are worried about their wallets, high-end discretionary spending is the first thing to get cut.
And that hurts premium categories like Mexican imports.
For sure. And the impact isn't uniform. The data gets really granular when you look at specific ZIP codes. Management said that results in high Hispanic ZIP code areas are significantly worse than the general market.
Which ties directly into affordability concerns. When the budget gets tight, consumers trade down to cheaper domestics or just buy less often.
And they gave a perfect example of this targeted economic pain, California. Management called California the single biggest problem for their beer volume.
And they linked that weakness to delays in what they call 4,000-calorie jobs.
Which is a bit of industry jargon, but it's basically shorthand for large-scale, physically demanding construction jobs.
Higher-wage jobs that employ a lot of their core demographic, the male Hispanic consumer who are also high-volume consumers of their beer.
Exactly. So when big construction projects are delayed because of high interest rates or economic uncertainty, those workers are underemployed. That instantly hits the spending power of Constellation's core audience, and that's why a massive market like California is hurting so badly.
So on the flip side of that debate, management tried to downplay the big structural factors everyone else is talking about, like the GLP-1 weight loss drugs.
Right, the whole Ozempic phenomenon. They believe the impact from that is currently relatively minor, which is a pretty big claim given how much focus that's getting across all consumer goods.
We have to scrutinize that. I mean, are they being complacent? Their argument is that the impact is spread too thin across the population to really move their needle right now.
But they did acknowledge a different structural risk: cannabis substitution. They admitted cannabis could become a bigger factor down the road, especially if consumers have to choose where to spend their limited discretionary dollars.
A choice between a six-pack of Modelo and a high-end cannabis product, that could definitely pull volume away.
It could. But for now, management is adamant that the overwhelming driver is the immediate pinch on the consumer's pocketbook.
Okay, so moving from the macro down to the actual brand health, the portfolio had some clear winners and losers.
Which is pretty typical during economic stress. And it actually showcases the resilience of their overall strategy, even in a downturn.
Let's start with the flagship Corona Extra. It's been somewhat challenged, with depletions down about 7%.
That's a concerning drop for such an iconic brand. But management argues that Corona still provides an exceptional halo for the whole family of brands.
So even if people are buying less Corona Extra, the brand equity lifts the perception of the entire portfolio.
That's the idea. And you can see the strength of that halo in the rest of the portfolio. That's where the real excitement is. Pacifico is still on a tear, up about 14% in depletions.
And Victoria was also a standout, up around 19%.
These smaller but high-end brands are definitely capturing consumers who are either trading up from domestics or trading across from other imports.
And Modelo Especial, despite everything, is still dominant. Depletions were down about 4%, but it still holds the critical title of the #1 beer brand in the U.S. by dollar sales.
That's the key: dollar sales, not volume. It confirms their pricing power. Even with a slight contraction, it's generating the most revenue in the entire category.
The Modelo Chelada brands also showed resilience, growing around 3%.
And their innovation is paying off massively. Corona Sunbrew was highlighted as a huge success. It's the #1 new brand in dollars and the #4 share gainer in the whole beer category this year.
That's a huge win. It proves that even cautious consumers will spend on something new and exciting if the value is there.
And to address those affordability concerns directly, they've made some targeted price adjustments. They reposition Modelo Oro and Premier at a somewhat lower price point.
A subtle but important move. It's a way to keep consumers in the franchise, even if they have to trade down a little bit, rather than losing them to a competitor entirely.
It's smart. And speaking of pricing, they affirmed their long-term strategy. They're sticking with that 1 to 2% pricing increase algorithm over the long haul.
So they're not abandoning the strategy that's driven so much of their growth. They'll adjust based on the market, but the philosophy of using pricing power is intact.
Absolutely. And that's critical because that pricing is needed to offset some significant cost pressures, which I think brings us to our next segment.
It does. It's clear the volume decline hurt the top line, but what happens when that lower volume meets their massive fixed cost base? That's where you get the margin squeeze.
And that's why we need to transition now and dive into the beer segment's cost structure and the specific pressures that led to that 200 basis point contraction we saw in Q2.
This is where the sheer magnitude of the operational headwinds really becomes clear.
The gross profit for the beer business was down a painful 9% year over year. And this was driven by a powerful confluence of factors that dragged that margin down from 42.6% to 40.6%.
And we have a very detailed breakdown. The single biggest driver, of course, was the volume decline itself.
Right. The drop in shipment volume resulted in a massive $118.3 million decline in gross profit. When you lose that much revenue, but you still have to run those giant breweries, it's just incredibly difficult to absorb.
Layered on top of that, there was a $42.9 million increase in the cost of products sold, or COGS.
And within that COGS increase, a few things really stand out. Most notably, the tariffs on aluminum cans.
They hit hard. It cost them $22.6 million in Q2 alone. And this isn't a temporary thing. This is a government-mandated tax on a key input.
And management said the full-year impact for fiscal 26 is expected to hit a staggering $70 million.
$70 million. I mean, think about that. That's a huge, unavoidable structural cost. It forces a discussion: can they source cans domestically? If not, their long-term margin target has a permanent $70 million hole punched in it.
It dramatically raises the stakes for their cost management team to find savings elsewhere, just to stand still.
Beyond the tariffs, we saw manufacturing inefficiencies that stemmed directly from that lower volume. There was a $10 million unfavorable impact from fixed cost absorption.
Okay, so can you break that down for us? What exactly is fixed cost absorption in this context?
Sure. So when Constellation builds a multi-billion-dollar brewery in Mexico, they have huge fixed overhead, cost depreciation, insurance, staff salaries. They budget those costs, assuming they're running at or near full capacity. But when production levels decrease, as they did this quarter, those same fixed costs get spread across fewer cases of beer.
Exactly, which makes each case more expensive to produce. They're essentially paying for a fully utilized factory that's running a little under capacity, and that gap costs them $10 million.
Then you had logistics adding to the headwinds, an $8 million increase in transportation costs.
And finally, depreciation was $6.7 million higher, which is a direct, unavoidable consequence of all their massive capital investments in Mexico. It's necessary for the future, but it's a margin drag today.
So on one hand, you have all this intense pressure, but on the other, management highlighted their countermeasures, their cost management and efficiency initiatives.
And these are generating truly substantial results. They're fighting back hard. In Q2 alone, the net benefit was nearly $65 million.
And year to date, those savings initiatives have generated over $105 million.
That is a huge offset. Management highlighted things like moving to larger 60-foot rail cars and implementing double stacking. It's an engineering solution to a financial problem. If you can squeeze twice the product onto a single train, you slash your unit logistics cost.
These efficiency gains are essential, but they prompted a crucial question from analysts. If volumes stay suppressed for longer than expected, can that long-term margin target of 39 to 40% actually be sustained?
And management was very clear, very confident. They affirmed that 39 to 40% is best in class for the whole industry. They reiterated their confidence in a return to growth, driven by those savings and the eventual easing of the economic pressures.
They're making a pretty high-stakes bet that the macro environment will improve.
They are, but the near-term guidance does reflect the immediate pain. The full-year outlook implies a lower operating margin for the year, around 38%.
Which is lower than what they just posted.
Yeah.
So that implies margins are actually going to get worse in the second half of the year. Why would that be?
The management team clarified that. It's mostly structural and timing related, not inflation. They expect a 100 basis point headwind from fixed overhead absorption.
Because the second half of the year is when they schedule more of their major maintenance.
Exactly. Production slows, so those fixed costs get spread over fewer units again. And they expect another 60 basis points of headwind on incremental margins. It's just the normal cadence of their operations.
And crucially, they specified they are not seeing a big pickup in inflation in the back half.
Right. The pressure is predictable. It's a function of their volume and their investment cycle, not some new, unexpected material inflation. That's a vital distinction.
Okay, shifting gears now. We have to talk about the radical transformation of the wine and spirits segment. This business has been through, well, radical surgery.
It's almost unrecognizable from a year ago, mainly because of those huge 2025 wine divestitures and selling off SVDA vodka. So we have to constantly rely on the organic metrics here to understand what's really happening.
Let's look at the reported numbers first, just to see the scale of that impact. Reported Q2 net sales, they plummeted to just $136 million. That's down 65%.
It's a staggering drop. And even worse, reported operating income fell deep into negative territory. It was a loss of $19.8 million, down 128%.
A huge loss on what's now a relatively small business.
So that reported decline is just noise. What really matters is the organic performance of the high-end brands they kept. Organic Q2 net sales were down 19%.
And organic U.S. wholesale shipments, so the product going to distributors, were down a staggering 20%.
That sounds absolutely brutal, like the business is just shrinking away.
But, and this is the critical positive metric management was clinging to, depletions were actually up 2% year over year on an organic basis.
And that is the single most important number in this entire segment. It means consumers are buying the new premium portfolio more often than distributors are ordering it.
So while shipments were plummeting 20%, consumption was rising 2%. It signals that the brands they kept, Rufino, The Prisoner, are actually succeeding with consumers.
And that leads right into their strategic narrative. The total pivot to a premiumization focus. They intentionally shed all that volume to purify the portfolio.
Management cited some really impressive sales momentum here. Looking at the 12 weeks Circana data, their key brands are surging. Rufino up 2 points, The Prisoner up 4, Unshackled up an incredible 11 points.
And Harvey and Harriet, a newer acquisition, was up roughly 23 points. Plus Maya Campo, the tequila brand they built from scratch, is also driving growth.
So this confirms that the premium brands they chose to keep are flourishing. Management said their main goal this year was just to stabilize the top line and beat the market, which they say they've done for 6 straight months.
This gives them confidence in the long-term plan, even as they go through all this short-term pain.
So let's drill down on that negative operating income. Why did a business designed to be high margin suddenly lose almost $20 million?
The organic gross profit declined by about $26 million. And the drivers really highlight the temporary messiness of this whole restructuring.
A word management used multiple times.
They did. The key factors were operational noise. $10 million from unfavorable product mix, an $8.7 million decrease in contractual distributor payments, and about $5 million from the volume decline.
That distributor payment piece sounds like a one-time adjustment linked directly to the transactions.
It is. And management expressed strong confidence this whole margin profile will completely reverse in the back half of the year.
Their optimism hinges on seasonality and just things getting back to normal.
Right. The bulk of their sales happen in the second half, around the holidays. Plus, they have high-margin events like vintage releases in their direct-to-consumer business coming up.
They were really upfront about the first half being messy, but they argue that as those short-term adjustments go away, profitability should naturally stabilize.
However, the full-year outlook for wine and spirits is still extremely challenging. Organic operating income is guided to decline between 97 and 100%.
Which translates to a full-year operating margin of essentially zero.
No. It confirms fiscal 26 is purely a transitional year. It is not about generating profit. It's about planting the seeds for premium growth and cleaning up the balance sheet.
It definitely sets the stage for a high-stakes fiscal year 2027, where they have to flip that zero margin into double-digit profitability.
The pressure is on.
Okay, let's move to our final segment, covering the full-year guidance, capital allocation, and key risks. And it's extremely important to note that despite all the Q2 pain, Constellation largely affirmed its guidance.
Which is the strongest possible evidence of management's unwavering cyclical viewpoint. They really believe this pain is temporary.
The comparable EPS target, that key bottom line number, was affirmed. $11.30 to $11.60.
The reported EPS was updated a bit to a range of $9.86 to $10.16, just reflecting the accounting for the divestitures.
And for the whole company, organic net sales are projected to decline between 4 and 6%.
For the beer segment specifically, they're guiding to a decline of 2 to 4%, which is softer than they'd like, but importantly, the cash flow generation remains incredibly robust.
And that's the cornerstone of their whole capital strategy. Operating cash flow is still targeted at a massive $2.5 to $2.6 billion. Free cash flow is affirmed at $1.3 to $1.4 billion.
And that robust cash generation is what underpins their aggressive capital investment strategy, which is still fully committed despite the soft top line.
Total CapEx guidance is firm at about $1.2 billion. And the vast majority of that, about $1 billion, is dedicated solely to the beer segment capacity expansion.
The rationale here, even when volumes are soft, is their unwavering long-term confidence in the growth of Mexican beer. They are betting on a massive rebound, and they do not want to be caught without capacity.
It's a classic, build it now and they will come strategy. They're accepting short-term margin pain for what they hope is long-term dominance.
They're focused on adding 7 million hectoliters of capacity between now and FY28, pushing their total to about 55 million hectoliters.
And while they said they're reviewing ways to slow CapEx beyond FY26, this year's spending is pretty much locked in, which means that pressure from fixed cost absorption isn't going away anytime soon.
And their commitment to shareholder returns also continues. They bought back $298 million in shares in Q2.
Bringing the year-to-date total to $604 million. And more importantly, they reaffirmed their ambitious plan to return $4 billion to shareholders in repurchases between fiscal 26 and 28.
They are using this weakness to buy back stock at what they clearly see as a good price.
They also declared their quarterly dividend of $1.02 per share. And on the balance sheet, they've been disciplined, keeping their net leverage ratio right at their target of about 3 times.
And their debt servicing costs are actually providing a nice little tailwind. Q2 interest expense was down to $87.6 million from over $100 million last year.
That $16 million decrease is thanks to lower average borrowings and slightly lower interest rates. In this environment, that is a powerful advantage.
Finally, we should touch on the litigation risk. The company addressed that amended stockholder class action lawsuit, MISA versus Constellation Brands.
And notably, the amended complaint has shifted its focus. It now concentrates exclusively on allegedly misleading statements about the prospects of the beer business.
The allegations about the wine and spirits business are gone. It's fascinating. It's like a recognition that by selling off those brands, they've cleared the slate there, leaving the beer segment's future as the main point of contention.
The motion to dismiss is pending, but the fact that the legal focus has narrowed purely to the long-term viability of their core strategy is a risk worth monitoring.
So synthesizing the whole quarter, the key takeaway is management is sticking to its guns. They have a high-conviction, cautiously optimistic view.
They admit there's unprecedented volatility. They see the consumer pain, especially in California. They're not denying any of that.
But their actions affirming guidance, spending $1 billion on CapEx, confirm their belief that these problems are cyclical, not structural. They are weathering the storm to ensure they're perfectly positioned for the rebound.
They are taking short-term operational pain to guarantee long-term market dominance. The tension in that investment profile is really the most fascinating part of this whole story.
Absolutely. It tells you exactly where they see the long-term value, no matter what the current depletion numbers say.
So before we go, here's a final point for you to consider about that capital allocation strategy. Given that affirmed capital expenditure of $1 billion for the beer business to reach 55 million hectoliters by FY28, how will the company manage the pressure of high fixed cost absorption and maintenance spending in the short term, especially if these cyclical headwinds persist unexpectedly into fiscal year 2027?
They are betting everything on a cyclical rebound. But if they're wrong, and the pain is more structural or just lasts longer, that commitment to capacity will become a significant drag on future margin performance. It's a risk they acknowledge, but they are clearly betting against it.
With that, we conclude our coverage for this video. Thanks for joining us. Sheen Research, Mindful Markets, Measurable Meaning.